TheoTrade. This is Don Kaufman. It's September 19th, 2018. You are watching the Theo Night video. Well, markets, first of all, took a little bit of a breather in observance of Yom Kippur. The S&Ps finished the day up 3. Well, to me, that is what I term massively unchanged. You can see the Russell futures backed off a little bit in the Nasdaq. I have to say, though, the Nasdaq played a little bit of Mr. Toad's wild ride, having a decent-sized range for a trading day that really turned out to see nobody kind of committing on one side or the other. The other aspect that really kind of has resonated with us in the last couple of trading sessions is sector rotation. So where did they rotate into? Well, much to my dismay, they rotated into, again, financials today. Financials up by a tune of 1.7%. Now, you might ask yourself, why did they rotate into financials today? Well, it's a really good question. Possibly because bonds sold off. But bonds, people, they've been selling off. Again, don't overthink this one. This is just a very simple idea of let's sell, a number of key underlyings, including, for example, Amazon, and buy what has been beaten down in the last couple of weeks, which, again, this is what we expect in sector rotation. What's been beaten down has a lot to do with the financials. Now, in a day that's a little bit more docile like this, we have a bit of time to kind of reflect on the overall marketplace. And one of the things as options traders. Now, I don't want to be pigeonholed here. I trade stocks, options, futures, you name it. If there's a tight bid-offer spread, I'm pretty much going to trade it. Nevertheless, to discuss a little bit about the options marketplace, today we're going to have a quick discussion about Skew. Because, well, Skew right now is extraordinarily heavy. And for those of you that have no idea what a Skew is, all right, it has to do with the implied volatility of the out-of-the-money puts in the SPX, versus the implied volatility of the out-of-the-money calls. And there's actually an index called, well, Skew. And you can put this into pretty much any trading application, and it measures it. You can see Skew is really in unprecedented territory. If you've never looked at this before, you might not know what unprecedented territory happens to be, but anything, at or near the 150 level. And again, I'm going to show you here momentarily what this kind of breaks down to. But at any point, in history, since Skew has been recorded, we have not had Skew for any sustained period of time anywhere near this. I mean, listen, the Skew right now, we're clear up to 150. If you look back, and now we're back into 2011, 2012, 2013, 2014, Skew is nowhere near where it is, again, in the present. And this has been an unprecedented Skew. And you, if you're trading, whether it's stocks, options, futures, the Skew is impacting you. Whether you know it or not, it is absolutely impacting you. And to take a detailed look at Skew, we're going to go into the SPX. And the SPX, of course, is where the Skew is recorded. Now, Skew is recorded right around the 30-day mark. So it's an implied volatility right around the 30-day mark. In this case, we'll use the 29-day options. And all I wanted to show you is, what I am displaying here is these people are way out of the money. When I'm talking about like way out of the money puts, and I'll scroll through for just a moment. All right, obviously, in this particular circumstance, the SPX is trading 2907. Let's just call it 2900. You have puts out here, that are what? $500, $600, $700 out of the money. But let's bring some puts in there that have at least a little bit of delta, something to kind of work with. Let's look at puts that are about $200 out of the money. And again, with puts that are about $200 out of the money, in this particular circumstance, they're trading 370 at $4. The implied volatility is about 17%. That's $200 out of the money. Now, if we were to go equidistant out of the money on the calls, what's equidistant out of the money on the calls? Hey, you got to cruise right up here, and that happens to be about the 3,100 strike. Can't even believe I'm going to say that. And the volatility is right around 9.7. So again, the differential between these out of the money calls versus the out of the money puts is fairly staggering. And I'm just going about $200 out of the money. But the way that the Skew calculation works is it actually averages many of the out of the money options. And if we take a look here, these options, and I'm going to highlight this again, these options are just about $100 out of the money. They've got a 7% implied volatility versus 100% out of the money, or I should say $100 out of the money on the put side of things, which was take us down, of course, to the 2,800. They're trading for almost a 13 vol. This is what Skew is about. And you're like, okay, I get it. But how does it impact you? Okay? If you're going to be trading options in literally in any way, shape, or form, as I said, you're going to be impacted by Skew. Now, let me take you into a product that might be a little easier to kind of interpret. We could use the spiders, or we could possibly use the emerging markets. In this case, we use the spiders. And you open up an option that's about 30 days out. Let's tighten up the number of strikes in here. And I'm actually going to show you, again, a very direct example of this. If you were to go out and you were to purchase a spread, now, when you're buying a spread, like what we call an in-out spread, you're buying a spread and you can buy one strike in the money and you're selling one strike out of the money. So to kind of label this here for a moment for you. All right, here we go. So the option we're buying is right here. The option we're selling is over there. The problem is the implied volatility is going against you, right? Because you're buying an option at a 7.15 vol and you're selling an option at a 6.81 vol. Now, again, this might not seem like a lot, okay, but on a percentage basis, it's fairly substantial. On the flip side, if you look at that, again, the call spreads are going to trade and they're going to be expensive. On the flip side of that, if you take a look at the puts, okay, the very same spread on the puts, you're doing the opposite, okay? When I say you're doing the opposite, you are what? You're buying a cheaper vol and you're selling a higher vol. So when you buy a put spread, the Skew is effectively with you. Buying a call spread, the Skew is going against you. They're not priced identically. The call spreads are going to trade for more, which makes it at a time like this, okay, where Skew, and I just showed you this a little while, Skew is at the highest levels really ever recorded. It makes it near impossible to want to buy a call spread in really roughly any product, whether it's an equity product, an index product, okay? Now, you want to see some really phenomenal Skew? Take a look here in the emerging markets. The emerging markets ETF, which is trading right around 42.5, okay? If we wanted to do an in-out spread here, we could go out and buy like a 41, right? So buy the 41.5, maybe sell the 43.5 against it. Now, this is a spread. It's a $2 wide spread. Should be trading for right around $1, but you'll notice it's $1.10. Now, an almost identical spread. I'm going to bring up another spread, and it's the identical put spread. We're going to come by, and we're going to cruise over here to vertical, and I'm going to make this one a $2 wide as well, okay? Just to compare and contrast, right? Do you see the difference? Okay, for the most part, all we're looking at right now, all we're looking at is you have a $2 wide call spread and you have a $2 wide put spread. They're the same trades, and the underlying is sitting smack in the middle. Come on, the underlying is at 42.56, and yet the call spread is trading for 20 cents more than the put spread. Now, the savvy options trader, what might you want to do? Okay, now, doesn't mean that you can't get bullish. Buying a call spread in this case is bullish. Buying a put spread is bearish. But all directional bias aside, the call spread, is it really worth that kind of premium? I don't believe so. So right now in a lot of products, okay, if you want to get bullish, you're going to have to get a lot smarter than going out and just buying a call spread. Okay, you're going to have to do, a little bit more amplified strategies. What might you want to do? So obviously if you want to get bearish, hey, come on, if you want to get bearish, buy that put spread. Because that put spread, all right, if you want to get bearish, it's going to trade for 91 cents. The put spreads are trading cheap. Great. What do you do if you want to get bullish? If you want to get bullish, you got to get a little bit cuter with this. You got to go out there and do stuff, okay, like ratio back spreads. And this ratio back spread, okay, why might I want to use a ratio back spread to be able to get bullish? Because in that case, you're selling the at the money here in the EEM, which is 17.7%. And you're buying two slightly out of the money options that are 17.04%. That in effect, makes the skew in your favor. The only downside, when you're doing a ratio back spread, you're going to need a real burst to the upside to really make some money in this spread. Again, it's just, this is trading, and trading at times, you're like, oh, that's not good. It's hard to get bullish. Yeah, it's hard to get bullish in a bullish market. Imagine that with low implied volatility. But you have to basically be able to serve up trades regardless of market conditions. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.